Like and subscribe to my channel and click the bell icon to get new video updates.
Silicon Valley Bank. How a bank failed. Silicon Valley Bank was shut down by regulators on Friday, March 10, marking the largest bank failure since 2008. At the end of 2022, the bank had $209 billion in assets. Bank failures can have a variety of causes. Fraud, bad credit, or a mishap. Assets and liabilities matched. The bank's problems appear to be due to an asset-liability mismatch. A bank takes deposits from customers, who can be individuals or businesses, and then invests most of those deposits into loans or securities, but keeps some cash in reserve in case a depositor wants money back. Silicon Valley Bank wasn't a typical bank, which in itself isn't a criticism. Most of their deposits came from large corporations that were part of the technology sector. For example, a startup receives $100 million from a venture capital fund. It parks this money at its local bank. Another company may have a treasurer who gets the best possible short-term interest rate by investing in commercial paper and other financial instruments. The bank recognizes that this deposit base requires liquidity. Most banks invest most of their wealth in loans, but most banks have many small depositors who don't suddenly need their money. So the Silicon Valley Bank put most of its assets in U.S. Treasuries. There is no credit risk, so it sounds safe. Unfortunately, the best returns are typically found on long-term bonds, rather than short-term switches. The problem with long-dated bonds is that when interest rates rise, the value of old bonds that are still paying the old rate goes down. Bonds were worth $117 billion, but were bought for $127 billion. And that calculation of value went down as interest rates went up. The 10-year government bond, for example, ended the year at 3.88%, but hit 4.08% in early March. The rise in interest rates resulted in an even bigger loss for the bank. A company with $100 million in deposits is just an unsecured creditor. And it's easy for a company to move its money from one bank to another, or to buy